Joining us for a closer look at what's currently playing itself out on that market scene is Wayne McCurrie from FNB Wealth Investments. Wayne, a pleasure. Good afternoon to you.
Yes, good afternoon.
All right, Wayne, I want to start off with the rand. I mean, what's happening there? I haven't seen us this close to 20 to the dollar in a while. What's going on?
There's no new news that I can think of that's causing the rand weakness now. Maybe, just some dollar strength. The dollar share market did so well on the back of Nvidia's results that the dollar got a bit stronger. Maybe it's a delayed reaction to our budget speech where we are essentially putting our hands into the kitty and drawing out money that we shouldn't be drawing out of. Maybe that's the view. But there's no specific reason today or last night as to why the rand's going up towards 1940. We'll have to see what happens. It's a little bit strange to me that it's weakening so much today.
We'll hopefully get a little bit more information later about that one. Also keen to get your thoughts on markets, just digesting some of the big news that came out this week. Fed minutes, our own CPI here at home, and I think you've already mentioned the budget. It looks like we've munched on this, and we do have enough of it priced in, all of it, the minutes, the CPI, all of it.
Look, the South African inflation numbers were essentially on target. The month-on-month increase was still quite reasonable. There were a lot of technical reasons as to why the headline number went up, but that was anticipated by the market. So the inflation number in South Africa didn't actually affect the markets or the rand too much. The Fed minutes also were very much as anticipated, also no new surprises there. But even though there was much speculation in the last month or two that the government would tap into that unrealized foreign exchange gain reserve, the mere fact that they did it in 250 billion, I think came as a little bit of a surprise to the market. So although the budget was good when you look at the headline numbers, it was only good because we had this reserve that no one thought of beforehand, and now that we're in a difficult spot, all of a sudden this is the answer to lower tax revenues and increasing expenses. So that did come as a little bit of a surprise to the market. But the Fed and the SA inflation numbers there wasn't much of an effect because of them.
Also reflecting on the big news of the week, Wayne, I really want to get your thoughts on Pick n Pay. It was quite an update that came out of there yesterday, lots of information, but really we saw that share price down 16%, I think, at close of business. It is up 5.3% right now. I'm keen to get your thoughts on how market participants are digesting all of the information, from the possible listing of Boxer to a possible rights issue, to even the Ackerman family having less of a stake possibly in the future. And how that is resulting in what we're seeing it do today in terms of the share price.
Yeah, look, very similar to transaction capital. When the market gets bad news once, the share price goes down, but then the market sits back and says, the worst is over. The worst is now over. We know the worst. And then also it's now similar to transaction capital. You come with a second bad news announcement. The market does not like that at all. And that's why the share price was trashed so badly yesterday. The problem at Pick n Pay is SA supermarkets. The other businesses are doing quite well. And SA supermarkets, their competition is just eating their lunch. So they're overstocked for the festive season. They didn't get the sales they wanted to. They didn't get the margin they wanted to. Their debt went up by 4 billion rands, and they need money. So the market, even though the market knew Pick n Pay was in trouble, no one even spoke about a rights issue. Now, of course, when your share price is at these levels, the last thing the company wants and the last thing shareholders want is a rights issue. So it means you're truly pushed into a corner because you're issuing shares at an incredibly low price, which dilutes your earnings. So the market did not like this. So when you spoke about Boxer and the rights issue, it's not as though they proposed. They're happening. There's no other alternative. Then secondly, on the banking, on the banks that advance their money, you also never want to hear that the company is breaching the rules of the loans. In other words, the covenants of the loans. And that banks have had to waiver the covenants to actually still extend credit to the bank. It just shows you the extent of borrowings. So Pick n Pay is in a really tight spot, and it's never good news to issue shares when you're in a tight spot and your share price has been trashed.
I want to move away from them in a bit, Wayne, but I must also ask you, when Sean Summers returned, he was under the impression that all it would take was some fresh produce, and a rejigging of this stores. Is it possible that now the CEO has a complete view of all the things that are wrong, and now we can have a little bit more confidence in the ability to turn it all around? Yeah.
Look, it's quite normal when a company's in trouble and someone else takes over, they kitchen sink the results. They write off absolutely everything. They devalue everything. They put all the bad news into the financials so that the first or second year with the new person in, everything just looks great. But Sean's been there for a while now, and this is the second lot of bad news we've got. So yes, it can recover, obviously, but believe me, to take on Checkers, ShopRite in particular, it's not a one-year fix.
Yeah.
I mean, Pick n Pay has essentially been going backwards for 20, 25 years. You don't fix that in a year. You've got to change the complete management. You've got to change the culture. You've got to change how they work. You've got to change their system. You've got to change their merchandising. You've got to change the layout of the stores. You've got to attract customers back. This is not a quick fix.
Well, we'll be watching that one, Wayne. It can only get interesting from here. I'm keen to get your stock pick, but first I'd like us to reflect on counters that have found favor with your industry peers.
So I'm punting Pepkor, and for the simple reason that I think the most important thing at the moment is for shareholders to be aligned with management. And it's quite rare to find a company where management are aligned with you on the JSE these days. And so I'm punting Pepkor. The CEO, Peter Erasmus, who I consider to be a competent manager, has got 120 million share options. I mean, to put that in perspective, if he can get the share price to 26 Rand, he'll make himself $500 million. I'm sure he's enthusiastic to do that, and if he does that, he'll make us a lot of money too. So purely based on the alignment of shareholders and management, we're going with Pepkor. I think it's a great business anyway, but I think the main reason is the alignment of shareholders and management.
JP Morgan, it's just a macro review. One has seen the possibility of interest rate reductions getting pushed further and further and further down the year, and higher interest rates good for banks. JP Morgan in a definite uptrend, breaking to new highs. It's not going to shoot the lights out, but I think it's pretty safe in what's at the moment pretty volatile global markets.
The company I'm going for this week is the Trade Desk. Now, essentially what they do is they provide sort of an alternative to Google and Facebook within the digital advertising space. Now, to sum it up really simply, I would say think of a stock exchange, but instead of transacting on shares, you're transacting on digital ad space. So the Trade Desk doesn't actually sell ad space. They provide ad agencies with an exchange in which those agencies can buy and sell their ad space directly to clients. So now just to, I guess, contrast this against the companies I mentioned earlier, Google and Facebook, if you want to advertise on one of their platforms, you kind of have to pay the price they want you to pay. So Trade Desk allows you some type of price autonomy, which you can imagine advertisers really like. And in light of this environment where interest rates are quite high, advertisers are looking to get a lot more bang for their buck. And I think that really stands to benefit the Trade Desk. In addition to that, it's also an election year, and I think it computes that we're going to see a lot more spend in that space. So I think Trade Desk is very well positioned for the near future and for the long term. It's a very interesting company. I would encourage people to have a look at this one. But I must note the share is quite expensive. It's probably been expensive since it's been listed, but I do think that it is important to have some type of exposure in the sort of digital advertising space. And if you've not got Google or Facebook, this is definitely an attractive option. I would encourage people to have a look at this one.
Fantastic. A very diverse set of stocks there, Wayne, Pepkor, JP Morgan, and the Trade Desk. So what do you think of some of these counters?
Well, look, Pepkor, I do agree that I think it's a good company. It's well run. They've been quite competitive. Whether you would buy a share just because management has got options, because sometimes management can cut corners and take short-term views on the company just to get the share price up so they can make money. So they don't take a longer-term view. So I wouldn't buy any share just on the back that the management have got big shares in the company, but I do like the company. JP Morgan, I mean, obviously, we all know the company been around forever. Profit should be good. Interest rates are high. They're making nice margin. I got you. Trade Desk, I actually have looked at this one. I think it's a very good news story. I mean, I know the share price is expensive, but yes, I think it really is a good news story. I think they're providing a very valuable service at a decent price, and yeah, I like it.
And with that said, Wayne, which counter are you loving today?
No, I'm way more boarding it. I'm going for ABSA. It just looks so cheap. The banks are still making big margin in South Africa for the same reasons as JP Morgan. The interest rates are high. They got a nice margin, getting a 7% dividend yield, plenty of provision for bad debts. I just think the share price is too low, so I'm going for ABSA.
Fantastic. Always a pleasure having you with us, Wayne. Thank you so much for your time today. That was your midday markets update with Wayne McCurrie from FNB Wealth Investments.